Assalamualaikum warahmatullah and welcome everyone. In this video presentation, we will discuss events after reporting period as presented by MFRS110. The discussion about events after reporting period is actually very short. Let me sum it up in an overview of the subject. Imagine that we are a company. Say our financial year ends every 31st December. And we are now going into financial year 2021. Basically, in Malaysia, we are given around 6 months after the financial year end to submit the final versions of our financial statements or annual report. Period more than that would suggest that the information provided for the previous financial year would be deemed irrelevant, since by the 6th month, investors, for example, would already be asking about company's performance in the current financial year of 2021. Remember timeliness? Say for example, in our company, our policy is to complete everything by 30th of April, when, as at that date, the financial statements will be authorized for issue by the management. Now we know for a fact, after the financial year ends, business just goes as usual. There will be economic events throughout the year till end of the current year, 2021. The question that would be asked regarding these events is, should we consider these events after 31st December 2020 to be included in the report of financial year 2020? The standard states that yes, we could, but it is limited to only those within the period between the financial year end and the time when the financial statements are authorized for issue to external parties. Now you may ask, why should we even consider? Aren't those events occur after the financial year end? For that, we ask this question, should we consider all of the events within that period? Because it would be illogical, since those events are relevant to financial year 2021. So because of that, we should only consider some of the events within that period, those that are identified as adjusting events, referring to events that would confirm the conditions that exist at the end of the financial year, which also adjust the values of items already exist at the financial year end of 2020. Makes sense, isn't it? Now, what about non-adjusting events that are material, that they may affect economic decisions of users of financial statements? To that, the standard requires us to disclose. That is all about it. I told you it's going to be very brief. Now, the challenge for us, the preparers of financial statement, is to identify which of the events within the allowable period for consideration to be adjusting events and non-adjusting events. Obviously, we need to first understand what is adjusting events and what is non-adjusting events. Though the terms sound self-explaining. Having said that, what left to be discussed is, what is adjusting events? How do we do the adjustment required due to the adjusting events? And what is there to disclose? Let us start the discussion on definitions of important terms with events after reporting period. We already know from the overview just now that the events that we could consider to be added to the previous financial year's report are those occurring between the end of reporting period and the date when the financial statements are authorized for issue. The reporting period here is referring to entity's financial year. So after reporting period means after the year-end date. The date when the financial statements are authorized for issue depends on things like the management structure, that is, for example, how many levels of authorization will a report go through before it is authorized for issue, the statutory requirements, since different types of companies in different industries requires different requirements from the authorities, perhaps, and all these will determine the procedure that the management team need to follow to prepare the financial statements. Another thing that needs to be highlighted is that the term authorized for issue generally means where directors have reviewed financial statements and endorsed the financial statements to be issued to external parties, like shareholders and other interested parties. Now, these parties should be external in the sense that they are not part of the management that manage the business and overlook the running of the business. Thus, it will include those external parties that are brought in to help occasionally when they are needed. We will look at an example in a moment. Events after reporting period include all events up to the date when the financial statements are authorized for issue, even if those events occur after the public announcement of profit or of other selected financial information. Let's look at this example by MFRS 110. The management of an entity completes draft financial statements for the year to 31st December 20x1 on 28th February 20x2. On 18th of March 20x2, the Board of Directors reviews the financial statements and authorizes them for issue. The entity announces its profit and selected other financial information on 19th of March 20x2. The financial statements are made available to shareholders and others on 1st April 20x2. The shareholders approve the financial statements at the annual meeting on 15th of May 20x2, and the approved financial statements are then filed with the regulatory body on 17th May 20x2. So in this example, the financial statements are required to be submitted to shareholders for approval after the directors have authorized for issue. In this case, the end period will still be when the directors authorize the financial statements for issue to external parties, that is 18th of March 20x2, and not the date when shareholders approve the financial statements. Let us now look at another example by MFRS 110. In this example, on 18th of March 20x2, the management of an entity authorizes financial statements for issue to its supervisory board. The supervisory board is made up solely of non-executives and may include representatives of employees and other outside interests. The supervisory board approves the financial statements on 26th of March 20x2. The financial statements are made available to shareholders and others on 1st April 20x2. The shareholders approve the financial statements at their annual meeting on 15th of May 20x2, and the financial statements are then filed with a regulatory body on 17th of May 20x2. For this example, this company has a supervisory board. Now, this supervisory board consists non-executives and representatives of employees and other outside interests. Non-executives is basically those executives without responsibilities for daily management or operations of the company. Therefore, they are still external parties within the scope of the standard, since they are not involved in managing and overlooking the operation and running of the business. Therefore, in this case, the end date for the after reporting period will be up to 18th of March 20x2. That is when the management authorized the financial statements to be issued to the supervisory board. Other terms that we need to understand are the adjusting and non-adjusting events. The standard defines adjusting events as events that provide evidence of conditions that already exist at the end of the reporting period. In other words, taking the previous timeline, whatever events that we want to identify as affecting the values in previous financial year must be confirming the conditions that already exist at the end of the financial year, and therefore related to items already exist in the financial statement at the end of the financial year. The standard gives us examples of events that are identified as adjusting events and resulted in amendments of values already reported in the financial statements of previous financial year. A. The settlements after the reporting period of a court case that confirms that the entity had a present obligation at the end of the reporting period. B. the receipts of information after the reporting period indicating that an asset was impaired at the end of the reporting period, or that the amounts of a previously recognized impairment loss for that asset needs to be adjusted. For example, the bankruptcy of a customer that occurs after the reporting period usually confirms that the customer was credit impaired at the end of the reporting period, and the sale of inventories after the reporting period may give evidence about their net realizable value at the end of the reporting period. C. The determination after the reporting period of the cost of assets purchased or the proceeds from assets sold before the end of the reporting period. D. The determinations after the reporting period of the amounts of profit sharing or bonus payments if the entity had a present legal or constructive obligation at the end of the reporting period to make such payments as a result of events before that date. And E. The discovery of fraud or errors that show that the financial statements are incorrect. For non-adjusting events, it is defined as events that are indicative of conditions that arose after the reporting period, meaning we only consider those events that are not related to those items already exist at the end of the financial year, or that are clearly a condition that only exists after the financial year end. An example of a non-adjusting event is given by the standard in paragraph 11, where after the reporting period there is a decline in fair value of investments within the allowable period. The decline in fair value does not normally relate to the condition of the investments at the end of the reporting period, but reflects circumstances that have arisen subsequently. Thus, it does not provide evidence of the situation at the end of the reporting period. If the events that resulted in the decline has occurred by 31st December, it should be reflected in the value of the investment as at 31st December. Therefore, an entity does not adjust the amounts recognized in its financial statements for the investments. Similarly, the entity does not update the amounts disclosed for the investment as at the end of the reporting period, although it may need to give additional disclosure under paragraph 21. On recognition and measurement, for adjusting events, we shall adjust the reported amounts accordingly, and for non-adjusting events, no reported amounts shall be adjusted. Paragraph 12 states that entity that declares dividends after reporting period shall not recognize a liability for that reporting period simply because no obligation exists at that time. Such dividends, however, are disclosed in the notes in accordance with MFRS 101. The standard also reminds us that if, after the reporting period and before the financial statements are authorized for issue, the entity intends to liquidate or stop trading or stop being in business or has no other alternative but to do so, the financial statements of that financial year shall not be prepared on a going concern basis. This may also be indicated by an entity having a decline in operating results and financial position after the reporting period. Thus, it may need to test for solvency. Please remember that if the going concern assumption is no longer appropriate, the effect is so extensive that this standard requires a fundamental change in the basis of accounting, rather than just an adjustment to the amounts recognized within the original basis of accounting. If going concern assumption no longer applies, MFRS 101 requires a disclosure. As for the disclosure for this standard, it requires date of authorization for issue, updating disclosure about conditions at the end of the reporting period. If non-adjusting events after the reporting period are material, non-disclosure could influence the economic decisions that users make on the basis of the financial statements, Accordingly, an entity shall disclose for each material category of non-adjusting event after the reporting period the nature of the event and an estimate of its financial effect, or a statement that such an estimate cannot be made. Examples of non-adjusting events after the reporting period that would generally result in disclosure include a major business combinations or disposing of a major subsidiary, announcing a plan to discontinue an operation, major purchases of assets, classifications of assets as held for sale in accordance with MFRS 5 or other disposals of assets, the destructions of a major production plant by a fire, announcing or commencing the implementation of a major restructuring, major ordinary share transactions and potential ordinary share transactions, abnormally large changes in asset prices or foreign exchange rates, changes in tax rates or tax laws enacted or announced after the reporting period that have a significant effect on current and deferred tax assets and liabilities, entering into significant commitments or contingent liabilities, for example by issuing significant guarantees, and commencing major litigation arising solely out of events that occurred after the reporting period.